Have you ever wondered why valuation is critical in business? Well, valuation is like the heart of finance. It's the process of estimating the worth of an asset, whether it's a company, a property, or even an idea. This process is key in fields like portfolio management, business transactions, corporate finance, and even for legal and tax purposes. By understanding the business, forecasting its financial performance, and applying the right valuation model, we can make informed decisions. With this understanding, let's delve into the key principles in valuation. Valuation is not a random process, it's guided by key principles. First, value is defined at a specific point in time. Secondly, value varies based on a business's ability to generate future cash flows. The market also plays a role, dictating the appropriate rate of return. Net tangible assets can impact value, as does the transferability of future cash flows. Finally, liquidity, or how quickly an asset can be converted into cash, has a hand in shaping value. Now that we know the principles, let's explore different valuation methods. Asset-based valuation is a popular method used across industries. This approach determines a business's worth by calculating the net asset value, essentially what you'd have if you sold off the company's assets and paid all its liabilities. Now let's delve into the four main types of asset-based valuation. First, we have the book value method. This is a simple calculation using the company's balance sheet, where the total liabilities are subtracted from total assets. Next, the replacement value method. Here, you estimate the cost to recreate the business from scratch, considering the current market prices. Thirdly, there's the reproduction value method. This involves determining the cost of reproducing the company's physical assets right down to the last paperclip. Lastly, we have the liquidation value method. This is what you'd get if you were to sell off all the company's assets quickly, usually at a discount. As we wrap up asset-based valuation, let's move on to income-based valuation. Income-based valuation and market value approach are two other commonly used valuation methods. Now, let's take a closer look at income-based valuation. This method seeks to determine the value of a company based on its capacity to generate economic benefits for its owners. One way to do this is through the economic value added method, which calculates the net economic profit that exceeds the company's total cost of capital. The capitalization of earnings method, on the other hand, calculates the expected return on investment. And then we have the discounted cash flow method, which estimates the value of an investment based on its future cash flows adjusted for the time value of money. Moving on to the market value approach. This method estimates a company's value based on real market prices of similar companies or assets. The empirical or statistical approach, for example, uses historical data to estimate the value of a company. Then there's the comparable company analysis, which compares the company to similar ones in terms of size, industry, and other characteristics. Lastly, we have the heuristic pricing rules method, which uses rules of thumb based on industry standards to estimate a company's value. Each of these methods has its advantages and limitations, and the choice will depend heavily on the specific circumstances and the nature of the company being valued. Having covered the main valuation methods, let's touch on other important concepts and methods. Apart from the main valuation methods, several other concepts and methods play significant roles in business valuation. Starting with due diligence, this is a process of validation, where a potential investor scrutinizes the seller's representations. It's like peeling back the layers of an onion to reveal the core truth. For instance, if a company claims that its patented technology will drive future profits, due diligence would involve verifying the patent's existence, its ownership, and its potential to deliver the promised returns. Next, we have mergers and acquisitions, a corporate strategy where a company combines its assets with another or acquires it outright. Think of it like a recipe. You can mix two ingredients to create something new. That's a merger. Or you can just add an ingredient to your existing recipe. That's an acquisition. These strategies can boost a company's value by enhancing its competitive advantage or expanding its market presence. Divestitures, on the other hand, involve the disposal of a company's assets or business segments, often sold to a third party. It's like a garage sale, where you get rid of items you no longer need, freeing up space and resources for other purposes. Lastly, we have other valuation techniques, like the return on investment-based valuation method, which assesses a company's profitability, and the dividend-paying capacity method, which gauges a company's ability to pay dividends to its shareholders. We've covered a lot of ground on valuation concepts and methods today. Let's summarize what we've learned. Valuation is a complex but essential aspect of business. It's a critical tool in portfolio management, business transactions, and corporate finance. Remember, value is defined at a specific point in time and can be influenced by factors like future cash flows, transferability, and liquidity. The main valuation methods include asset-based, income-based, and market value approaches. Other concepts include due diligence, mergers and acquisitions, divestitures, and ROI-based valuation. Keep these points in mind as you navigate the world of business valuation. Thanks for watching.